Stocks can seem confusing, but they are easy to understand with simple examples. This essay is for anyone who has ever felt overwhelmed by the world of finance, for the beginner who wants to grasp the core concepts without getting lost in jargon or complex charts. We are going to peel back the layers of Wall Street and look at its most fundamental parts in plain, simple language. You do not need a degree in economics or a background in banking to understand how this all works. The goal here is not to make you an expert overnight, but to give you a solid foundation, a clear lens through which you can view the financial news and make sense of the conversations around you. Over the next few minutes, we will journey through the essential building blocks of the stock market. We will start with the very basic idea of what a share of stock is, using a real-life example that makes it instantly relatable. From there, we will explore the simple reasons why the prices of these shares go up and down every single day. We will then discuss the different approaches people take to trading, from patient long-term investing to fast-paced day trading. We will also demystify stock indexes and hedge funds and see what Wall Street truly means, then wrap with simple next steps. Let's begin this journey toward financial clarity together, one simple concept at a time. So, what exactly is a share of stock? At its core, a share is a small, fractional piece of ownership in a company. When you buy a share, you are not just buying a digital certificate or a number on a screen. You are becoming a part owner of that business. You have a claim on its assets and a portion of its profits. Think about a large, delicious pizza. Imagine Pizza Paradise Inc. wants to expand and open new restaurants. To raise money, it sells ownership slices to the public. The whole pizza represents the whole company. The owners cut it into 1 million identical slices. Each slice is a share. Buy one slice, you own 1/1,000,000th of the company. Tiny piece, but you're an owner. If the company does well and grows, your slice becomes more valuable. You're entitled to a portion of the profits, sometimes paid as a dividend. A small cash reward. Shared ownership is the foundation of the stock market. Now that we know a share represents a piece of a company, the next logical question is, why do their prices change so much? Stock prices are in constant motion, ticking up and down every second the market is open. While countless factors can influence these movements, they boil down to two powerful forces: news about the company's performance and the timeless law of supply and demand. These elements create the market's daily rhythm, reflecting the mood and expectations of millions of investors. First, let's consider news and events. Good news often pushes a stock price up. For example, Pizza Paradise Inc. announces quarterly sales much higher than expected. Investors get excited. That suggests the business is healthy and growing faster than anticipated. People feel more confident about future profitability, so they buy shares and pay a higher price. On the other hand, bad news can do the opposite. Declining profits, a product recall or a new competitor, and prices can fall. The second major driver is supply and demand. When more buyers than sellers bid, prices rise. When sellers flood the market, prices drop. Headlines can spark short-term flurries, but over years, sustained performance drives long-term trends. Learn to separate noise from value. Finding your pace. Common ways to trade stocks. Once people decide to enter the stock market, they discover there isn't just one way to do it. Different people approach buying and selling with different goals, time horizons, and levels of risk tolerance. There are several common strategies, each with its own philosophy and methodology. Understanding these main approaches helps you recognize the activities that make up the market. The four most common styles are buy and hold investing, day trading, swing trading, and index investing. Buy and hold is long-term. Investors buy strong, well-managed companies and hold for years or decades. The goal is not short-term action, but to benefit from steady business growth over time. Favored by legendary investors like Warren Buffett. It requires patience and resisting panic during downturns. For many beginners, it's a less stressful, historically effective approach. At the other extreme is day trading. Noors or day scores. Is danger in the sprinter of finance. In and out within minutes, dozens of trades. It demands tools, mastery of mechanics, and high risk tolerance, not ideal for beginners. The power of many, understanding indexes and index investing. You often hear, the market was up today, but what does that really mean? They're usually referring to a stock market index. An index measures the performance of a group of stocks, a scoreboard for part of the market. Instead of tracking thousands of companies, it gives a snapshot of the overall health of the stocks it represents. It's built from selected stocks, often the most influential, tracked together. Two famous indexes, the S&P 500 and the Dow Jones Industrial Average. The S&P 500 includes 500 large U.S. companies across industries, from tech to healthcare, and is often a proxy for the U.S. market. The Dow tracks 30 major companies. Smaller sample, Moxibals and Bonding Sai. Malix of Dalin Crace and Maning Surgen Nahozistars Rai. The power for everyday investors comes via index funds. An index fund can be a mutual fund or an ETF aiming to replicate the index's performance. It simply holds all the stocks in that index, in the same proportions. Instant diversification. Instead of one company, you own a slice of hundreds. Simple, low cost, and popular for beginners. The exclusive club, a simple look at hedge funds. Beyond individual stocks and index funds, you hear about hedge funds. A hedge fund is a private investment partnership pooling money from wealthy individuals and large institutions, like pension funds or endowments. Their goal? Generate high returns whether markets rise or fall. They face fewer regulations and can use complex strategies. Despite the name, many take significant risks seeking outsized profits. Think of hedging like an umbrella. Protection during storms. For example, they might short a stock to offset other positions. They can use leverage, derivatives, currencies, even private companies. Flexibility brings potential for high returns and very high risks. Participation is restricted to accredited investors due to risk. Fees are typically 2 and 20, far higher than index funds. After fees, many struggle to beat simple index funds long-term. Wall Street and beyond, the financial heartbeat and your next steps. So, where does all this activity take place? The symbolic center is Wall Street. It's a real street in New York, and shorthand for the U.S. financial industry. It refers to big banks, the NYSE, NASDAQ, and institutions that move global money. Companies raise capital by issuing stocks and bonds, and investors trade them. Its health affects businesses, jobs, and the wider economy. Today, you don't need to be on Wall Street, and markets are on your computer or phone. Online influencers help demystify investing. Creators like TJR share practical tips and straightforward lessons, but always do your own research. Cross-check with news, respected books, and company filings. Recap: a share is a piece of a company. Prices move with news and supply and demand. Styles range from buy and hold to day trading. Index investing offers simple diversification. Indexes are market scoreboards. Hedge funds are exclusive, higher risk pools. Key takeaway: start small, invest regularly into a low-cost broad index fund, keep fees low, and learn as you go.